Community Roundtable. I can't believe we're 2 months into this call and we've had so much fun doing it. I'm Daniel Arias. I'm the We Fund LA team leader, and of course, we're joined by the We Fund LA team. Leslie, Evan, Joanne are all on the call, and they'll be helping moderate today's call. As you all know, this call was born out of a desire to serve, educate, and inspire. And we've been fortunate to have a wide range of speakers that have covered everything from real estate industry updates to medical experts giving us a COVID update. And we even had Tina Bryson talking to us about parenting during the pandemic. And the feedback has been incredible. I mean, these calls have really become the symbol of our commitment to you, our commitment to your business, and our commitment to your clients. And we are all stronger together. One of the things that I've personally enjoyed about these calls is our ability to really bring the entire community together, regardless of what company logo sits on your business card. All of you are really the magic of this call, and we're excited to have you guys on. But with that, as we all appear to be getting busier and the purchase and resale market continues to accelerate, we've decided to make this call every other week. So starting next week, starting today, right? Today we'll have a call. We'll be dark next Tuesday, and then we're gonna pick it up again on Tuesday, June 2nd. Same time, 10:30, but we're gonna move it to every other Tuesday. So I'll be updating the calendar reminder. I'll leave the call open if anybody wants to jump on next Tuesday and hang out, you can do that, but we won't have another speaker until June 2nd. And so we're trying to confirm that, and we should have an announcement hopefully by the end of the week. So anyway, with that, let's get into it. Our guest speaker today is a talented tax wizard who has a black belt in all tax-related matters. If he's not already preparing your tax return, you'll likely be seeking Tony's guidance after today's presentation. I have to say, not only is Tony a brilliant tax pro, he's also an incredible public speaker. He's clear, he's concise, he's articulate, and he's got one of the fullest beards in Glendale. So with that, Tony, thank you for being with us today and welcome to the call.
Thanks a lot, Daniel. Thanks everybody for joining. I see a lot of familiar faces in the room today. So welcome to those of you who don't know me. Once again, my name is Tony Watson. For those of you who do know me, hi everybody. Today we're going to cover quite a bit of information about the CARES Act. I know that there's probably a lot of questions about the HEROES Act that has passed one stage of its acceptance stages, and there's going to be a lot more changes coming up this year as well. So we'll probably throw together another couple webinars between now and December 31st. But I'm going to bring you the most up-to-date information as of today. With the CARES Act, with the PPP loans, the EIDL loans, some things to look out for as you move forward throughout 2020, with identity theft, with fraudulently filed applications for the PPP and the EIDL loan, and kind of the back end auditing process that we're going to see if you did qualify for one of those loans already. We're going to talk a little bit about the QBI deduction, the mortgage interest deduction, the property tax deduction that changed in 2018 a little bit, but we're going to spend most of the time today on the CARES Act. I'm going to go ahead and share my screen if that's okay, Dan.
Yeah, no, appreciate it. We're really curious to hear kind of what strings are attached. And as I mentioned earlier, Joanne, Leslie, and Evan will help moderate the call. We have a couple of questions, or did you want to just jump into your presentation?
Yeah, hey, shoot. You guys can throw questions at me. Sure. Yeah.
Yeah. Mm-hmm. Leslie, go ahead.
I think it might be great, Tony, if you just get started, and then if any of our questions that we had kind of ready for you are not answered through your presentation, then we can go ahead and ask them as part of the Q&A. I'd say go for it. I'm sure you've done this a million times during this time, so we'll let you go for it.
Yeah, webinars have become a daily thing here at Robert Hall.
Yeah.
We have about 45 people working here, not as of the moment, but we have about probably 20, 30 people in the office right now. And I have this big webinar poster on my door, but it seems to be a daily thing. And I'm glad that we're all still connecting with technology. So today we're going to talk about the CARES Act. How will it help you? How will it change your tax scenario? How are you supposed to utilize some of the money that you've qualified for? And mainly and specifically within the small business and real estate industry. So jumping kind of right into, well, there's a background of who we are and what we do. If you don't know who we are, I'm not just some guy sitting with a green screen in my bathroom, right? I'm actually working out of my office in Glendale right now. I've been preparing taxes for 15, going on 16 years now. I service roughly about 1,200 tax filings per year, mostly self-employed business owner tax returns and real estate professional tax returns. So just to give you a little bit of background of about me. COVID-19 changes. So the PPP, the EIDL loan, we're going to spend a good chunk of today's portion on those two topics. We're going to talk about mortgage forbearance. We're going to talk about accelerated depreciation for rental property owners or individuals who are thinking about jumping into the rental property sector. We're going to talk about the stimulus checks. That'll be a pretty short conversation. Then we're going to talk about identity theft and how that's impacting essentially everything that's going on in the world right now. Identity theft has been the #1 crime in America for quite some time now. It is now the #1 crime globally. So there are a lot of things that obviously in the real estate industry, there's a lot of due diligence and check boxes that you have to mark off when having people sign their name on the dotted line. But now there's even a further step that you'd really need to take for yourself. To make sure that your social security number is secure, to make sure that if you feel like your identification number has been compromised, you probably want to reach out to your tax advisor or directly to the IRS and acquire what's called a PIN number, which is unique to your social security number. So we're going to get into that as we move forward today. Let's jump right into the payroll protection program. Some of you, if not all of you, have already either gone through the process of applying for this. Some of you may not have applied for it, which is fine as well. The PPP plan actually is the only loan still being funded. The PPP program still has money to lend out, whereas the next topic, the EIDL loan, which we're going to talk about in a second, they have stopped accepting applications as of now, but they are still processing any applications that have already been filed. The payroll protection program was very unique. It was a very unique part of the CARES Act because it was meant to essentially keep people on payroll. A lot of individuals thought that, okay, well, payroll protection program, that means that I can only apply for this if I have payrolled employees. No, that is not the case. This works for businesses that might have 30, 40, 50 employees. This works for businesses that have you as the employee, just as a sole proprietor. But there's a very simple calculation, but when it first was rolled out, a lot of people were very confused about how they were going to qualify for this particular loan. But the federal government, since the dust has settled and there's been 2 rounds of funding of the CARES Act, essentially, with the EIDL and the PPP loans, a lot of people have understood that it's actually a very simple calculation of how to figure out how much you can qualify for from the PPP program. So when you apply for the loans, obviously you can go directly to the SBA website and apply that way, or you can apply through your financial institution. Now, every bank is different, so I can't speak on behalf of all banks, but I know that US Bank, for instance, my branch here in Glendale, they were reaching out and offering a lot of help with applying for the PPP program and the EIDL loans. However, some people were going directly to the SBA website and going through the whole application themselves, but a lot of questions arose from the application process. What numbers do I need to pull off my tax return? What it actually is my monthly average net income? What do I consider my compensation from 2019? If I haven't filed 2019 yet, what numbers should I be using? And so a lot of these questions, our phones were ringing off the hook. Gosh, day 1 of the CARES Act even being in conversation. And so we were able to assist clients in pulling these numbers off of their tax returns. For the sole proprietor, for instance, the most common client that we're seeing apply for the PPP loan, for the sole proprietor or the single member business owner, essentially what you would use is one of 2 numbers. Either you pull your 2019 tax return and you look at your bottom line profit on your Schedule C, so on your business return, whatever your net revenue was after all of your expenses were taken into account. You took that number, you divided it by 12, and then you multiplied it by 2.5, which that calculated essentially what your estimated PPP loan would have been. So let me give you an example. Let's say that in 2019, I was a self-employed realtor. I made $120,000 in profit in the 2019 tax period. If I take $120,000 divided by 12 months, that's $10,000 per month. I take that multiplied by 2.5 months because, get this, the federal government, when they passed the CARES Act, they thought that the economic shutdown or basically the pandemic would only happen over a 2.5-month period. So the way that the PPP loan was structured was that you had to figure out what your monthly net revenue was and multiply it by 2.5 months because they figured that you only need 2.5 months of support. Well, that's probably long gone by now, and hopefully the next round of funding will have a little bit of an adjustment for that. But essentially at $10,000 a month times 2.5 months, that gave you a $25,000 PPP loan. Now, some of the misconceptions about the PPP loan is that it's not taxable. Well, yes, maybe. However, you need to understand that when you are funded for a payroll protection relief program, you are supposed to turn around and use that to pay for some sort of payroll, whether it be to pay yourself or to pay your employees that you are trying to keep on payroll. It worked well with restaurants, for instance. If you had 15 employees, the payroll protection program was meant to not only pay you as the business owner, but also to keep all 15 employees on payroll. And so some businesses were able to do that, but restaurants were probably hurt, one of the worst hit industries, just because people can't go and sit in a restaurant right now. And so some of those employees actually had to be let go, even though the PPP plan was funded. They just didn't have enough revenue to keep everybody on payroll. But let's say that you're that sole proprietor business, you get the $25,000 PPP loan, and you're ready to use it. Well, the federal government and the SBA division under the CARES Act stated that you have a certain period of time to spend this money. Not only do you have a certain period of time to spend it, but you have to spend it on very specific expenses. You can't just take the $25,000, go out and buy a new car, right? The payroll protection program was meant for you to receive this money and to turn around and utilize it for a very short list of business expenses. The main one being payroll. So 75% of your payroll protection program loan needs to be applied to some sort of payroll, whether it be to pay your employees or to pay yourself. But you have to make sure that it stays consistent with what you've earned either over the 2019 tax period or the 12 months leading up to basically the time that you were impacted by the COVID-19 outbreak and the pandemic. So the consistency of revenue and payroll needs to be there. Well, let's say that you take that 25,000 and you allocate, let's say 100% of it to payroll. Well, sure, under SBA rules right now, if you utilize 100% of the PPP loan for a forgivable expense, meaning payroll is a forgivable expense, you will not owe that money back to the SBA lender, right? You won't owe it back. However, it does not necessarily mean that it's not taxable, right? Because remember that you don't have to pay it back to them, so you don't have to include it as revenue, but what did you use that money for? Well, if you're a sole proprietor, if you're a single business owner, you utilize that PPP loan to pay yourself. And as payroll or compensation to yourself, guess what? Next year, when you file for 2020, you pay income tax on the money that you paid yourself. So just because something is forgivable doesn't necessarily mean that it's not taxable to you as the business owner. So just be aware of that. There's some misconceptions about that. Well, it's forgivable, I'm not going to pay income tax on it. Well, understand that yes, your business, you as the business owner don't have to pay income on the loan amount, and you don't have to pay it back because you used it for a forgivable expense. But when you turn around and paid yourself, you actually paid yourself a compensation in this tax year. So next year when you file, you got to report it as taxable income. So 75% of that loan minimum has to go towards paying for payroll. The 25% that's left over can be used to pay for business rent. It can be used to pay for business utility expenses. If you have a loan on the building that you work out of, which could potentially be an in-home office of some sort, you can even allocate that towards business loan interest. And one of the major expenses that we're seeing a lot of clients use this money for is, aside from payroll, is medical expenses. So you can also utilize this to pay for self-employed health insurance. So those are all forgivable and allowable expenses that will allow you to be relieved of paying the PPP loan back. Let's say, heaven forbid, you got the PPP loan and you can't utilize all of it to make payroll expenses, right? You can't pay yourself that much, or you can't pay your employees that much, or you just have money left over at the end of the day. Don't worry. The PPP loan, actually, if you're not utilizing it fully for the forgivable expenses, it defaults to a loan. And over the first 2-year period, 24 months, your interest rate on the PPP loan is only 1%. So it's a heck of a deal. No matter how you look at it, it's a heck of a deal. And a lot of clients are saying, well, should I send it back? If I don't utilize it all, should I send it back? Well, I have to play devil's advocate. I have to look at both sides of the equation. One, yes, I think that money should be sent back because there are other people who need this money. But I also have to think of how much fear and uncertainty there is in business as of today. Literally today, as of yesterday, as of a week ago, it's all been pretty much the same. We don't know what the future holds for us. We don't know how long. We know how long we're going to be shut down, but they keep extending it. So we don't know the overall trickle-down impact of how this will affect our businesses as business owners. So I have been suggesting to people, hey, listen, if you think that you don't need it and that you're not going to need it for the next year to 2 years, send it back. If that makes you feel like you're doing a good thing by putting money back into the system for other people to utilize, great, go ahead and do that. But If you feel like 3, 4, 6, 12 months down the road, you may need to utilize this cash to keep your business afloat, to do more marketing, to pick up business and kind of expedite and take advantage of the down economy and coming out and really start to build business again. Utilize that money for that. It's a 1% interest rate on whatever that amount is that you couldn't use for the forgivable expenses. So just understand that the PPP loan essentially is a very, very low interest rate loan, number one. Number two, yes, it does need to be utilized if you want it to be forgivable for very specific expenses. But heaven forbid you can't meet those requirements. Don't worry, you're not going to go to jail for not utilizing it in specific ways. It does default to a loan with a 1% interest rate. So that's still, once again, a great deal no matter how you look at it. The impact of loan on taxes or future lending, remember that the PPP loan, it doesn't necessarily mean that it's not taxable to you. It just means that whatever you paid yourself, if you only paid yourself the 75% amount, that you'll have to include as compensation on your 2020 return next year when you file for this tax year. The impact of future lending, yeah, it does show up as a debt to your business. It's treated a little bit differently if you apply for the PPP loan under a corporation rather than as a sole proprietor, but it's not nearly as much of an impact as the EIDL loan, which is what we're going to talk about next, and the impact that that has on your credit score and your future lendability, so on and so forth. I did want to touch on the employee retention credit and kind of squash some misconceptions about two things that people are getting confused. The employee retention benefit under the payroll protection program was really meant, remember, the PPP was meant for you to retain employment. A lot of clients are saying, well, I've already laid off all of my employees, or I've already laid off my assistant. Do I need to go back and rehire them once I have the PPP loan? Well, yes, you should attempt to hire the same employees because if you've laid them off, remember the PPP plan, once it was funded, it was meant for you to retain those employees on your payroll. Now, if they've already gone and applied for unemployment, this kind of puts you in a sticky situation because when you go and hire them back, well, they have to shut off unemployment. And right now, they might actually be collecting more in unemployment than they're actually getting paid by you as the business owner. So there is a little bit of a conflict right there. And so you need to have that discussion with the employee. If they don't want to come back and work for you, don't worry. It's not something that you're gonna be penalized for, essentially. But you do need to retain employment or keep things consistent as it was up to the time of the pandemic and the economic shutdown. So that's the employee retention part of the payroll protection program. But then there's something called the employee retention credit, which is something completely different. The employee retention credit is something that could refund you if you issue payroll to yourself through W-2 and through Paychex or ADP or some formal payroll company. The employee retention credit can allow you to apply for up to a $5,000 payroll tax credit to offset essentially $5,000 of payroll taxes. If you have employees, you can do this for each employee up to $10,000 in compensation, meaning that you have a $5,000 credit per employee. So this is going to be a huge credit for a lot of individuals to apply for, especially if they have payrolled employees that they're paying, one, or number two, if they themselves are on payroll through their own corporation. A lot of my realtor clients, for instance, they're either set up as sole proprietors or they're set up as employees of their own corporation. For those of you who are my clients in the webinar today, you probably are very familiar with this with your corporation. If you are on payroll through your corporation, we can apply for this employee retention credit probably at the end of the third or the beginning of the fourth quarter to give us enough time to process everything before the end of the calendar year. For those of you who are sole proprietors, this employee retention credit is not meant for the sole prop. It is meant for somebody who is actually issuing payroll out of their business. Now that brings in another kind of topic here. If you are a sole proprietor, this is definitely the time to have a conversation with your tax advisor as to whether or not incorporating is right for you. Because through the process of incorporating, if the numbers make sense, it's not right for everybody, and it's very much a right and a wrong time to incorporate. But if you have thought about it in the past and you know that moving forward, the income is going to continue to grow over the next couple of years and that you're already kind of hitting specific numbers, incorporating might actually reduce overall liability, number one, reduce your risk for audit, number two, but also allow you to apply for this employee retention credit that I've been discussing. But once again, it has to be done through a formal payroll process, which obviously any accounting firm can set you up with. And if you have more questions about that, we can obviously answer them today. Or at the end, I'm going to offer a free consultation and a way to get in touch with us. But we can dive more into that detail if we need to. Now, I did want to also point out that at the very bottom of all the slides today, it does say this information is subject to change without notice. And I see that the webinar is being recorded. So once again, there is information that will be changing over the upcoming months. And we're going to be coming back to you with more up-to-date information, especially if the HEROES Act does fully pass. And there is, $3 trillion in additional funding. There could be a number of changes, also addendums to the CARES Act. Nothing that we're talking about today will be changed because this is already kind of set in stone, but there might be some adjustments that may benefit you in future months. So we'll bring back that information once we have it. The payroll protection program, once again, it's meant to keep people on payroll. If you want to make sure 100% of the loan is forgivable with SBA, you got to meet those specific spending requirements. Once again, you can use the payroll protection program for payroll expense. You can use it for rent. You can use it for utilities. You can use it for medical expenses. You can use it for mortgage debt payments, not on your primary residence, but on a business location, which once again, if it's a rental property that you work out of and we have that structured on your tax return, there may be some ways to utilize it for that as well. And then also if you have business debt. With SBA loan, for instance, if you already had a small business loan, you can actually utilize part of the PPP loan to pay for the interest expense on the business loan. So there's a very short list of relievable expenses. We can dive more into detail about that if we need to, and also answer any questions at the tail end of today's webinar. The EIDL loan, one of the more common loans that people have been applying for and that has really only been available since the pandemic actually occurred. SBA has been around for a long time. SBA has been giving out small business loans, since I first started working with Robert Hall, probably even way before that. So, but as of this pandemic, as of the economic shutdown, the SBA lenders have come up with this EIDL loan, which kind of comes in two separate forms. And this is where a lot of people got confused. When they went to originally apply for the EIDL loan, there were two loans that you could apply for. Well, not really two loans. One loan that you could apply for, and then something called a grant or an advance of the $10,000 premium or $10,000 grant amount. A lot of clients who went and applied for it, they realized that they were only getting $1,000 amounts, or either $1,000 even, or maybe a couple $1,000s. And it was all based on how many employees they had. Well, if I'm a sole proprietor, just me individually working, and I went and applied for the EIDL advance, then I only received $1,000 of that because I got $1,000, I'm the only employee. If I had 2 or 3 people on employment and I plugged in that number and I checked the box for the advance or the grant of the EIDL, I got $1,000 per employee plus $1,000 for myself. If you applied for the actual EIDL loan, you were applying for a loan that could range up to, at one point, $2 million. As of late, I think over the last 2 or 3 weeks, the SBA lenders have decided that they're going to drop the $2 million max loan amount down to $150,000. So because the first round of funding went so quickly, they realized, well, we shouldn't be giving out $2 million loans. It's not the billion-dollar corporations that are applying for the EIDL. Some did, like the Lakers did, but they returned it, don't worry. But some businesses, they were applying for it and they were getting these $2 million loans, and that money went very quickly, $480 billion or something like that for the first round. Then another round came, and that went quickly as well. So right before they actually shut down the application acceptance process, they dropped the loan amount, the max loan amount, from $2 million to $150,000. Now the EIDL loans, they are actual loans. The $1,000 that you got, if you got the grant or the advance, that does not have to be paid back. And as of today, once again, information could change on this. As of today, the federal government is not planning on taxing the $1,000 amount. So it literally doesn't have to be paid back. It's not income to you. It's not taxable as of today. However, the EIDL loan that you applied for, if you got $40, $50, $60, $100, $150,000 of this EIDL loan, that actually is a loan at 3.75% interest over a 30-year term. Now you can imagine if you got a $2 million loan at 3.75%, that's a heck of a deal, right? I'm not going to call it free money, but that 3.75, that's a heck of a rate. But it depends on how much you got, right? And this actually is something where they pull your credit. They have to make sure that you have assets or cash flow in order to pay off this debt. It's an actual loan. And so understand that even though it's an actual loan, you're paying it back, you do have to use the EIDL loan for specific business expenses. Basically anything that was ordinary, necessary, and legitimate for your business to operate up to the time that the pandemic hit. And so there are very strict requirements of what you can and can't use this money for as well. It is not a forgivable amount, though. That's the difference between the PPP and the EIDL. The major EIDL loans that you're applying for, they're actual loans with actual interest rates, and that's why your credit is pulled. That's why they want to make sure that you have enough assets they can leverage against, and to make sure that you can afford to pay it back. That's really the main base for the EIDL loan. But once again, two different loans that you're applying for, either the advance or the grant, and the EIDL straight up loan. If you got the $1,000, great. It's just when you applied for the loan, if you meant to apply for the regular EIDL loan and you check that grant or the advance box, that's the $1,000 that you got. You didn't apply for the other loan. A lot of clients in the early phases of applications, when they were submitting applications, they actually had to apply twice. They had to apply for the regular EIDL and then the EIDL advance. I don't know if everybody had to do that, because once again, all banks are different. Maybe when you filled out the application, the bank replicated it, unchecked the advance box, and submitted both for you. Because I had some clients who only submitted one application, but received both, not only the advance, but also the EIDL, the big loan. So it really all depends. Every lender has been accepting and processing applications differently. Some banks were refusing to help their clients fill out the application. Some banks were assisting with that. You walked into your bank, the actual SBA lender or whoever was working with you, they actually filled out the application for you. They needed copies of tax returns and bank statements and everything, but it was a pretty easy process if you got in there early enough. Now, because they've shut down the application acceptance process and they're only processing current filed applications, we're seeing a little bit of a delay. I personally think, this is just a personal opinion of mine, I think that this will open back up in the next couple months because once the federal government realizes how bad this situation really is financially for people, I think that the EIDL loans will be refunded through, if the full HEROES Act does pass, I think they're going to refund EIDL. PPP still has money though. So understand that if you haven't applied for PPP, go ahead and do that, because remember that we don't know what the future has in store for our businesses. The future is uncertain. So this money is there not for you to spend frugally. This is really meant to keep your business afloat during times where your business has slowed down ultimately. 2019, 2018, 17, those were somewhat great years for a lot of people. 2020 came to a halt very quickly. And so a lot of people are still trying to figure out what the future of this year has in store for them. Those of you who are savers, you're probably sitting pretty decently. You have enough money to kind of weather the storm. But for those of you who have just entered into real estate or who chose to sink a lot of your 19 and 18 profits back into your business to really ramp up for this year, all of your money's tied up in other things and the cash flow is very low right now. So I would suggest applying for the PPP loan, even if you don't think you need it, just to have it as a security blanket. That's what it's there for. And worst case scenario, if you can't utilize it for the forgivable expenses, it does become a payback loan, but only at 1% over a 24-month period. It's there to assist and help you in times of need. So just keep that in mind. Don't be prideful about this kind of stuff because everybody's hurting. And unless you're a multi-billionaire, right? And even they're looking at their brokerage accounts thinking, man, what the heck is going on? So just understand that this is there and meant to protect you and your business and to make sure that you don't fall into a worse of a personal recession, as we've already seen over the past couple months. Mortgage forbearance. Obviously, this is actually one of the things that we've been servicing more phone calls about over the past 3 months than any other question is. My rental property owners have been calling saying, hey, my renters have stopped paying rent. I can't evict them. I can't just kick them out. California says, no, there's a halt on evictions. Technically, they don't have to pay you rent until we lift that particular piece of the legislation. And so you, as the borrower from the bank, you have to make the mortgage payment. You still have to pay property taxes. You still have to pay whatever those expenses are that you're incurring on behalf of your tenant. And so obviously the first rule is that if you can afford to pay your mortgage, pay your mortgage. Because this is not a relief program. In fact, I don't even consider this personally to be a benefit, but it does allow people to extend their time to pay their mortgage. 180 days is the first extension, basically time frame that a lender will allow for. It's not necessarily a relief plan though, right? It's just telling the borrower that, hey, if you can't afford to make your mortgage payment now, we will give you 180 days to make that mortgage payment. No additional fees or penalties or interest will accrue, but the interest that you're having to pay on the actual mortgage payment, that continues to accrue. And so at the end of the 180 days, a lot of the questions that were coming into our office were, well, at the end of the 180 days, am I going to have to pay all of my mortgage payments and all of the accrued interest back all in one lump sum? Every lender is different. Some lenders have allowed individuals to modify their loans. Some lenders have allowed them to quickly do a refinance if their credit score and debt to income was okay. So we've seen a lot of refis. I'm sure, Dan, you've seen a lot of refis as well. Obviously, there is this kind of transition for property owners just because they are not collecting rent at the moment in parts of all over the U.S. And so this 180-day extension gives them time to make that mortgage payment without feeling like they're just going into their savings and not having enough money to put food on the table, right? These are things that people are realizing that, how are they going to pay their next month's mortgage? How are they going to put food on the table for their kids? There's a lot of concern and uncertainty right now. Let's say that at the end of the 180 days, you still can't make your mortgage payment. There is another 180-day extension. So 360 days you can go without making a mortgage payment. Once again, you need to talk directly with your lender about your options, okay? Could this impact your future lendability? Absolutely. But at the end of the day, if this is something that you need as sort of like a safety blanket to make sure that cash is liquid for you as a property owner, as a business owner, these are the options that you have. But once again, I cannot stress this enough. Your lender is the person you need to talk with to figure out what plan is right for you. Just don't stop making your mortgage payments and assume that the bank is going to think, oh, well, poor Susie, she can't make the mortgage payment, so we're going to go ahead and give her the mortgage forbearance out 180 days. You need to reach out to them. You need to talk with them directly to make sure that this is the right plan for you. So just be aware of that. For the rental property owners, one of the major benefits that is built into the CARES Act, aside from the PPP and the EIDL loans and mortgage forbearance, is the ability to change the accelerated or depreciation amounts that you're deducting against rental property, both for retail business property, restaurants, and also residential rental properties. Under the old tax bill, or actually dating right up until the CARES Act was passed, you were allowed to take major improvements to property and depreciate them over 27.5 years if it's residential, 39 years if it's commercial. The federal government stepped in under the CARES Act and said, hey, what we're going to do is we're going to take that depreciation lifespan of 27.5 years, we're going to cut it almost in half. We're going to drop it all the way down to 15 years. So for the rental property owners in today's webinar, and for those of you who know about how rental properties work, depreciation is essentially a phantom expense. It's the value of your building that you own divided over a certain period of time. That's what depreciation on a building is. The way that you depreciate big improvements, like you gut a kitchen, you put a $100,000 kitchen in your home, technically that $100,000 is supposed to be spread out over 27.5 years. The federal government says that under the CARES Act, you no longer have to leave it at 27.5 years. You can actually drop it down to 15 years, which gives you almost double the write-off for the improvement that you're making. Some actual improvements, QIP qualified improvement property, can be accelerated 100%. But it really all depends. Just because you gutted your kitchen and spent $100,000 putting a kitchen in 2019 or 2020 doesn't mean that you get a $100,000 write-off. That is something that gets the 27.5 year to 15 year benefit. Other like appliances that you purchase, and there's a whole list of qualified improvement property. I can't go through it today, but if you are more interested in learning about the qualified improvement property and what is included as 100% write-off versus 15 years, we can definitely go into that in more detail. You're going to see a lot of people amending tax returns to get this benefit. It's not only meant for 2020, you can also amend 2019 if you've already filed, and you can also amend 2018 if you've already filed. I want you to be aware, though, that when you amend a previous year's tax return, you significantly, number one, significantly increase your risk for audit, and two, it might not make that much financial sense for you. This is something a financial analysis needs to be done on this to make sure that if you're going to go back and amend all of these returns, that it's going to save you thousands and thousands of dollars. If it saves you a couple $100 in tax, the risk of increasing risk for audit, the potential for increasing your risk for audit doesn't make sense at that point. So this is a conversation you need to have with your tax advisor. We're also seeing a lot of people looking back into 19 and 18 and 17 to see if their 2020 losses, because make no mistake, just because the economy may open again very shortly, depending on when that happens, people have already lost in this year. People have not collected enough rental income to cover their mortgage payments or their property expenses, so their properties are at a loss. The businesses just aren't generating a lot of revenue because sales are down, and so the expenses continue to accrue, but the income is down. So next year, when we file for 2020, if your income happens to be negative, it's a scenario called a net operating loss. Also built into the CARES Act, which includes accelerated depreciation as write-off, you can actually take your losses from 2020 and carry them back to 19, carry them back to 18, carry them back to 17. You can carry them back up to 4 to 5 years, depending on what election you make. It's called a 1045 carryback, and this allows you to take the losses from 2020 and receive part of your liability that you paid in previous years back as a refund. So this is a very complicated election. It's brought back under the CARES Act. It actually went away in 2018 under the Trump tax bill, and now they've brought it back under the CARES Act to make sure that, hey, if you paid sizable liabilities in past years and you're losing this year, we will give you the benefit, the IRS will give you the benefit of electing a carryback to offset previous year's liability. Once again, very, very complicated election, but it is absolutely something that is available for you as business owners. So just keep that in mind. Let's talk about the stimulus checks really quick. A lot of clients have said that they haven't received their stimulus check yet. Do not worry. Checks are still being cut. Direct deposit is no longer available, but people will still continue to receive their checks throughout the 2020 tax period. In fact, you could go the whole 2020 tax period without receiving a check, and then you can apply for the $1,200 amount on your 2020 tax return next year when you file for this year. So just because you didn't receive it doesn't mean that you aren't going to get it, okay? The $1,200 does not have to be paid back. It is not taxable. It is literally $1,200 that is, well, nothing's free in this world, but it's $1,200 for you free, however you want to take a look at that. Somebody's got to pay for it on the back end, but we'll see who that is in future years. The phase outs for qualifying for this, if you are single, $99,000. If you're married filing joint, phase out is $198,000. The phase in period for a single individual is at $75,000. So if you made under $75,000 AGI, you got the full $1,200. If you made over that up to $99,000, you slowly started to phase out from being able to receive the full $1,200. Same with the married filing joint, started at $150 AGI, phased out at $198. You get $1,200 per adult and $500 per eligible child. Will there be additional checks in the future? Yes. However, next year, if you don't get one in this calendar year, next year you'll apply for this on your individual tax return. So you still will get it. It'll just be a credit against whatever liability you have or added right directly to your refund for 2020. Okay, so be aware of that. One thing that I did want to wrap up on the CARES Act is the increased identity theft, the increased amount of fraud over the past 3 or 4 months. Some of you may have been sitting online, you know, because we're all quarantined at home at the moment. Some of you might have bought things online and they still haven't come. The tracking number is fake. You felt like you got an 80% discount on a purchase, and all of a sudden you realize, well, I paid with PayPal, but it still hasn't come. They said 5-day delivery or whatever. Understand that there are a number of fraudulent scams and schemes out there right now. So be aware and look out for these particular things. We put together a pretty short list here of things that you need to be aware of. Fake websites. These companies or these fraudulent scammers abroad, both here in the US and abroad, they've been setting up fake websites with discounted rates on certain things that you might be looking for. They have all this data. You can get this data if on the black market. You figure out what this person is into, and then you could just flood their Facebook feed and their Instagram feed with things that you might be interested in. And as soon as they hit a purchase price, they've got you. You click on the link, it goes to their Dropbox or their basket. You purchase it, it never shows up, and they take your money and they're on their way. So we'll look out for fake websites. Phishing and vishing, you can look that up online. It's just a way to scam people out of their personal information. Spoofed government and health organization communications, miracle cures. I remember right when the pandemic started to really settle in, there were a couple stories that came out in the news with people coming up with these miracle cures or vaccines. There's no such thing. They're still working on it, okay? So don't fund any projects or group funding projects to come up with a cure. Ignore all that stuff. It's all a scam. Fake job postings. Just be very aware of that. They're going to look for all of your personal information. How to recognize the scam. You need to look out for people really pushing you to act now. Includes requests for personal, financial, or medical information. Never send copies of tax returns to people unless it's to Daniel, your lender, right? Include or directs you to open attachments. So don't open up any attachments in Facebook messages or links in emails. Obviously, that's all very generic stuff. And then starts off with the generic greeting, but there's misspelling and grammatical errors. Just be aware of these things. We have seen a significant spike in fraudulently filed returns. Number one, fraudulently filed applications for the PPP, the EIDL loans. People's tax returns for 2019 bouncing back because somebody had attempted to file under their social security number. That's actually been going on for quite some time. But if you feel like you've been compromised, reach out to all of your credit card companies, reach out to all of your debt collectors, and obviously reach out to the IRS so that the IRS can assign your social security number a 6-digit PIN, which is unique to your social security number. And unfortunately, I'd say fortunately and unfortunately, you're going to have to get this PIN number every single year, probably for the rest of your life. This is really the only way that the federal government can now create a second unique tracking method for your social security number. If the IRS has been hacked, Anthem Blue Cross has been hacked, Sony was hacked, there's a lot of companies that have been hacked. Your personal information is out there. So just be aware that this stuff is readily available for people trying to scam you as business owners. Before I go on, I did want to mention once again, RHA offers free consultations. If you wanted to dive more into the in-depth questions on what we've discussed so far, obviously I'll stick around and answer questions today, but if they're more personal questions, text RHA to 38470. We can get you set up with a free 30-minute consultation over the next week or 2 weeks so we can get you those answers. Part of 2018's tax reform bill involved something called qualified business income deductions. And for those of you in today's webinar, all probably self-employed individuals receiving 1099, maybe even a little bit of both W-2 and 1099 income, as long as you have either self-employed income or rental income reported on your return, you have what's called QBI, qualified business income. And qualified business income is a key point to receiving one of the major benefits under the 2018 tax reform. QBI is essentially, once again, self-employed income or rental income. And once you figure out whether or not you have this type of income on your return, you want to figure out, okay, well, what's the income threshold that I need to be below in order to qualify for this benefit? Starting in 2018, this was a benefit. If you don't know whether or not you've qualified for this QBI deduction, you can look at your 2018 or 2019 tax return, and on the very first page of your 1040, there should be a line item that shows qualified business income. Now, if your income threshold for 2019 was over $321,400 if you're married filing joint, and over $165 roughly if you're single, you have phased out from being allowed the full QBI deduction. However, up to about $420,000 for married filing joint and up to about $210,000 for single, you still qualify for a portion of the QBI deduction, which makes 20% of your self-employed business income tax-free. Let me say that again. If you are a self-employed realtor and your profit in 2019 was $100,000, let's say you're a single filer, you are under the threshold to qualify for QBI, so that made 20% of your $100,000 tax-free. That's $20,000 of tax-free income. If you're married filing joint, let's say both of you are real estate professionals, you're each making $150,000 in profit. That's at $300,000 QBI income. You're under the $321,000 threshold. That made 20% of $300,000 of your income tax-free. That's $60,000 of tax-free income you received in 2019. So if you think, well, the QBI deduction really doesn't matter to me, it's 20% of your income that you don't pay tax on. That is a massive, massive credit. It significantly reduces liability, so much to the point that we actually saw some tax returns where they owed as much to California as they did to the IRS. Now, who has the higher tax rate? Obviously, the IRS does. So when you look at your tax return, of course, your question is, well, why am I paying so much to California? I'm paying almost equal what I'm paying to the IRS. Well, it's because the federal government made 20% of your qualified business income tax-free. That's what dropped your federal liability down equal sometimes to California's overall liability. So just be aware that this is a major benefit only for individuals who have qualified business income that they file on their returns. Once again, free consultations to review past year's tax returns. If you're already a client of mine, make no mistake, I've already applied for the QBI deduction for you. I double and triple check that on every return that I file. But for those of you who aren't a client of Robert Hull & Associates, just double check to make sure that your accountant knew about the QBI deduction benefit. It is not something that the computer system automatically does for you. These are elections and certain, to be frank with you, certain boxes that you have to check in the tax return in the tax software to qualify you for either the full QBI or a portion of it. If you're a specified trade or service business owner, like if you're an attorney or if you're a medical professional, you might not qualify for the full QBI, if any of it at all. But real estate professionals, boom, your industry qualifies for 100% of it if you meet the income thresholds, okay? Just to dab on the mortgage interest and the property tax deduction real quick, nothing's changed from 2018 to 2019. Mortgage interest still is limited to the first $750,000 of acquisition debt. on primary residencies and second homes. When you turn around and rent out a property, this is a huge pitch to people to buy rental property because I personally believe, even though we're in the midst of a pandemic, it's never a bad time to buy real estate because you should never plan on selling it unless you're going to exchange it. But mortgage interest is still a great overall tax write-off for people. There is no cap at $10,000 for the mortgage interest. This is a misconception. Where mortgage interest is capped like property taxes, two completely different things. Mortgage interest is still allowed fully on up to the first $750,000 of debt if you purchased the primary or the second home after December 15th of 2017. If you bought the home before December 15th of 2017, you are grandfathered into the old tax bill, which allows you the interest deduction on up to $1 million of acquisition debt. And remember, these limits are only on the primary and a second home, not on a rental property. Rental properties have no limits. You could have a $5 million mortgage on a rental property and you're allowed 100% of the interest as a write-off because it is a business. When you move into the property as a primary or when you decide not to rent out the property anymore and use it as a second residence, then you see the limit to either $750,000 or $1 million, depending on what date you bought the property. Now, the SALT deduction is capped at $10,000 as of 2018. SALT stands for state and local tax. Understand this, though, that under the old tax bill, the one before 2018, there was already a limit in place as to what you could deduct in state and local tax. A lot of people didn't know this, though. If you were subject to something called alternative minimum tax, AMT, you were already limited on the amount of SALT deduction that you were allowed. Sometimes you weren't even allowed any of it as a write-off. That's the craziest thing about the old tax bill. And that was if your income breached roughly $180,000 of income. So that means that if you have two individuals filing on a tax return and you're making $200,000+ of income, under the old tax bill, you may have been subject to this thing called alternative minimum tax, which either limited or disallowed completely your state and local tax, which includes your property taxes on your primary residence, your property taxes on your second home, your DMV fees, your sales tax deduction, and your state of California income tax that you pay. Those were all write-offs on your tax return, but under the old tax bill, you were limited as to what you could write off of this deduction if you were making over $200,000 of income. Under the new tax bill, that limit of $200,000, that phase out, so to speak, jumped to $700,000. So now you can make up to $700,000, not be subject to AMT, and now you're allowed the full state and local tax deduction, but only up to $10,000. So we are seeing a lot of individuals who weren't really negatively impacted by this, but they just didn't understand how they were going to be impacted by it. They didn't understand why they were being limited, number one, and what kind of impact tax-wise it had on their individual tax return. These are not reasons for people to not buy property, right? We buy real estate because it is the most secure long-term investment you can park your money in. Whether the economy is good or bad, people will always need a place to live. I know that, you all know that. And that's why when we talk to clients about these deductions, sure, this is just the icing on top. This is the cherry on top, so to speak. You get a great write-off for it, but at the end of the day, you don't buy property for the tax write-off. You buy it because over the long term, property will never be worth what it was in 1950, in 1960, in 1970, 1980, 1990. I think we passed 2006 and 2007's peak values in like 2013, and the market is still pretty darn good. Inventory is what? I mean, I'll leave that up to the real estate professionals, but even in the midst of a pandemic, people are still looking to buy homes. So we understand that whether the economy is good or bad, there will always be a market for people to buy property. And once we come out of this pandemic and the economy really starts to boost again, property values are going to be right up to where they used to be, if not even more than that, because it's history, right? It's proven over the last 50, 60, 70, 80 plus years, however long we've been tracking this data. So just be aware of that. This is a great deduction still, but yes, it is limited at $10,000. But if you rent out the property, guess what? There is no limit to what you can deduct in property tax on your rental property because it is a business, just like the mortgage interest deduction. So keep that in mind. What else should you be doing when it comes to tax planning? Obviously, connecting with your tax advisor, connecting with your financial planners, putting a plan in place for this year. Even though it's via Skype and FaceTime, there's still a lot of information that you need to allow you to implement the right strategies to reduce liability, to shelter assets, and to essentially continue making money throughout this year without having to pay exuberant amounts of tax to the federal government or Uncle Sam at the end of the year. I did want to leave it on this, and we're going to open up for questions now, but if you have to go, if you have to jet to another call, or if you have more personal questions, go ahead and text RHA to 38470 and we get you set up with that free consultation. So I think we'll hop over to questions, right?
Awesome. Yep, Tony, thanks for all that great information. I've also posted your contact information in the chat box, so if anybody needs or wants to get a hold of Tony, I've put his website also on the chat box. Does anybody have questions for Tony? We can take a couple, and then I did want to open it up to some real estate updates. If you have a question, you can go ahead and unmute now.
Someone had asked me, Tony, in regards to the stimulus check that individuals are receiving. Is it safe to say, given that we've seen it in the past, same thing with the PPP, all of that, that the stimulus check will be income you'll need to report at some point next year, pay some taxes on it? What do you think about, what are your thoughts on that?
So as of today, the $1,200 that everybody is receiving does not have to be paid back. It is not a taxable amount to anybody. It literally was putting $1,200 in the pocket of United States tax-paying citizens and some who don't pay taxes, actually. You don't have to actually file a tax return to get this $1,200. It is not going to be taxable. It does not have to be paid back. In fact, the federal government has refundable credits, and then they have regular tax credits, right? And so the best example I can give is back in 2000, oh gosh, was it 2008 or 2009, they introduced the $7,500 first-time homebuyer credit, which had to be paid back. And then immediately the next year, they introduced an $8,000 first-time homebuyer credit that did not have to be paid back. So, and they didn't change the $7,500 amount. So for the government to issue all of these checks and tell people that it wasn't going to be taxable, it wasn't going to be income, and then all of a sudden next year tell them, hey, surprise, you're gonna have to pay tax on it. The government doesn't do that. If anything, they may make, if they extend the $1,200 checks and let's say they do it again next year, then that would be a whole new rule that you had to play by, a whole new playing field. But as of now, that $1,200 no longer, it does not have to be taxed, does not have to be paid back. You're good to go on that.
Another question was, now that obviously a lot of individuals, especially on this call, self-employed, but also working from home, do you see any potential benefits? There's been a limit, somewhat of a limit to what you can write off as a business use of home, but any kind of update on that?
Well, as of now, I mean, the current tax code does allow for the self-employed individual to write off a portion of their home as an in-home office. As of now, the Internal Revenue Service has not released any information about W-2 wage earners being allowed to write off an in-home office deduction. The 2018 tax bill actually took that, what's called a 2106 expense. They took it completely out of the tax code. So W-2 wage earners really aren't allowed any business deductions anymore. California still allows it. So we still put the in-home office deductions, the travel, the cell phone, all of that stuff on the returns because California allows for that deduction. But the federal government has not released anything for W-2 wage earners pertaining to in-home office deductions. Because I think they're expecting the employer to kind of make up for that. For instance, at Bob Hall requires us to work through the pandemic. We could either work here at the office or we could work from home. I'm not going to make a huge deal out of working from home because I actually really appreciate having a job, especially in today's day and age. So I'm not going to make a big deal with Bob Hall about it, but there are some clients who truly feel like, hey, if I have to work from home and I have to use my own cell phone, I have to use my own internet, that I should be reimbursed for that. And I think that the main thing that the federal government wants to make sure of with business owners is that they take care of that for their employees. That's not really a government thing that they need to refund. Now, once again, that's as of today. Could that change once we kind of wrap up the year? We have a presidential election coming up in November. A lot can change there. Number two, we have another 6 months left in this year for the Internal Revenue Service to introduce benefits when we get ready to file for 2020. Something might be in the pipeline, but nothing is written in stone as of now. I did get a private message really quick that I wanted to touch on. What if you received a stimulus check for a deceased spouse? Here's the thing about that. Technically, to be real honest with you, you could cash the check, and the government's probably not even going to come after you for it. But the way that they're handling it right now is they want you to write void on the check and send it back or not cash it. I'm not going to say do what you want, do what you think is ethically and morally correct. That's been a big issue, is that deceased individuals are getting these stimulus checks. And if you have a checking account open with that deceased individual still as an owner of the checking account, you can actually sign their name and go and cash it at the bank and literally convert it into $1,200 and $100 bills. And so a lot of individuals have been doing that. I'd say that the federal government probably isn't going to make a big deal out of this because the more money circulating in the U.S. economy, the better it is for the United States of America. So I don't know the overall back-end auditing potential of that. We don't have any case study. We haven't seen the government going after anybody for that. So the best advice I can give is do what you think is right. That's really the only answer I can give you as of now. So.
Awesome. Thanks for that, Tony. Thank you for being on the call today. We really appreciate all your insight. I'm sure your email inbox is going to be filled with a bunch of inquiries and new clients. So thanks for jumping on today.
Absolutely. Absolutely. Please let me know if anybody has any questions. Thanks again for including me.
All right. Thanks, Tony. Have a good day.
You too.
All right, so let's open it up to all of you. We definitely want to get a quick real estate update in the call today. I mean, our team has absolutely seen a sharp spike in purchase activity on both the pre-approval side and actual accepted offers. I think what's been most interesting is that in almost every single new escrow that we've had, it's been in a multiple offer situation. I think one of them was over 20 offers. We had to release loan and appraisal contingencies, and we had to commit to a very quick close. Leslie had a couple of them where I think they were under 17-day closes. So, I think we're seeing definitely a big spike. I think people are figuring out a way to conduct business in our environment now. So I wanted to open up to everybody and just kind of get a feel for what you guys are seeing. Obviously, if there's any clients that are expecting a major slowdown or drop in prices, that's not what we're seeing, but would love to open it up. Jan, if you're on the call, Jan Amami, and I'd love to hear how your Highland Park listing turned out. Jan, you on the call? Can't hear you. I think you unmuted, but we can't hear you. Maybe she dropped off. Okay, maybe Jan dropped off. Maggie, do you want to give us a quick Compass Old Town update? You're muted too. Let me unmute you.
Okay, here we go. Hi, can you hear me?
Got you
okay.
now.
Yeah, we did a company-wide survey. I think that I shared a little bit with Daniel. It was really interesting. The biggest concern for the agents in California, we had 900 agents respond, is the behavior of others as we move forward and relax our stay-at-home order. And the second one was the mortgage market. And I would assume that has a lot to do with jumbo loans. So, so that being said, the consensus is, and this is a national consensus with Robert Refkin yesterday, is that we're going to see our spring market in June through August. So it's just delayed a couple months. And I'm certainly seeing that with the activity level in our office, multiple offers. Colette just sold that Laurel in South Pasadena. I don't know how many offers she had, but it ended up going 240,000 over the asking.
Wow.
And so she has a backup on it for 210,000 over asking. So and also a short escrow all cash. So
wow.
Anyway, some crazy stuff going on.
Interesting. Jan, I see you're on the call. I don't know if you unmuted, if you can hear us. Say something. No? Jan Amami? Okay. Anselm, you just typed to me that you're on the call, you're writing an offer, you're homeschooling, you're multitasking. What are you seeing? What do you got going on over at Courtney and Kurt? Hold on. Should I unmute you? All right, go ahead.
So sorry, somehow I've lost my Zoom screen here, but yeah, it's really busy out there. The buyer market, the agents aren't really setting deadlines. I think they're kind of waiting to see how the market responds, to any given property, and then the bidding process is really compressed and really fast. So it requires being diligent and on top of any inventory. Because it's just sort of an unpredictable offering process. And yeah, it's multiple offers. Mostly for me in the zone under $1 million is where I see the most activity. But I'm starting to see that uptick, tick up in the sort of medium high price point as well, up to about 1.4, 1.5. So it's just buyers agents that got to be on their toes.
Yep. Hey, Joelle Winnicky, I see you're on the call. If you don't mind, what are you guys seeing? Do you guys see an uptick in open orders for new escrows?
Hi. Let's see. We did have a big opening week last week. However, we are down. The good news is that cancellation rates went down to 21%, and in the previous 2 weeks they were up at 24.7%. In a healthy market, we're usually between 17 and 20%. So, with all things considered, 1% is not much. We're heavy with the refis right now. We're usually 70% resale to 30% refis. And right now we're about 60-40. However, the 68% of the monthly closings were resales. So that's where we're at.
Awesome. Thanks for sharing. Kristen
You're welcome.
Hartwick, if you don't mind, are you seeing the same thing over at Glen Oaks? If you're on the call. No, I'm just calling randomly on people, but anybody else have anything to share, any wants, any needs? This is their time to pitch your property, talk about what you've got going on or what you're seeing. Okay. All right, we've got a lot of shy people on the call. With that, we'll end the call. I know we went a little over the hour, but as a reminder, no call next Tuesday. We're going to pick it up again Tuesday, June 2nd, 10:30. Thank you for everybody. Thank you everybody for being on the call. And if you guys want a copy of the recording, you can email any member of the We Fund LA team. We'll get it out to you guys later today. Have a good day.